Hello, good morning and welcome to this edition of Trading Hour. We are here in the studios and it's a Friday and that's a pretty important clue. For the markets, not too much going on, absolutely flat trends. Girls, hi morning. I think the way we see things, yesterday we were talking about this mid-cap rally emerging. Today even the mid-cap index has sulked, right? Yeah. It's down about 0.5%, but I'll come to the contribution plate in just a second. First of all, good morning and happy Friday to both of you.
Happy Friday and Eid Mubarak to all our viewers as well.
Absolutely. Okay, so very quickly to talk about what's moving higher and what's moving lower on the index. There are no clear trends, barring one sector, that's IT, and we'll talk a lot about IT as we go forward. But otherwise, it's just rotation that's going on. Today, if you were looking at Nifty gainers and losers, you'll see metal stocks, for instance, on the downside. IT is seeing some incremental gains. The plate comes up for you. ICICI Bank ahead of numbers, is a little optimistic. But look at HDFC Bank. It's on the other side of the screen, taking the market down. There's TCS that's seeing incremental buying, but a stock like Tech Mahindra, which is cooling off. Very hard to pick trends. Let's just pull up Reliance as well, because, of course, that's today's big story. Earnings post-market hours. And that stock also is not making any kind of a decisive headway in either direction, up or down. I'm talking about Reliance Industries. But Pavitra, I guess it's just been one of those phases for the market, right? That we're not getting any clear sense of either direction or even trends. It's one sector one day, another the other day. That's just how it's become.
Yeah, there's absolutely nothing really to look at, right? Today you mentioned the metals are a little bit under pressure. You have real estate, which is seeing some cuts again. But again, that space has rallied so much. So, I mean, coming in for cuts is not too much of a surprise. We have Oberoi, DLF. These are some names which are looking a little bit weak today in addition to the metals pack. The metals, by the way, outside of the index also, you have names like NMDC, SAIL, seeing some cuts. So do watch out for that. You have all of the numbers which have come through from insurance. So those stocks in focus as well. But like Surbhi was pointing out, you really have to look at individual stocks when you want to track the action, right? And clearly the stock of the day has to be Cyient. One more mid-cap IT company that posted results, and look at how it's gone.
And Cyient is a company which had already run up. So it's not that the positioning in the company was adverse. Right? The stock now, after a 5-6% gain that we are seeing today, is up more than 40% year to date at a time when the Nifty IT index is down 6%. So just take stock of the kind of outperformance. And with the gain today of 5%, the stock has hit a fresh 52-week high. Q4 numbers ahead of street expectations on revenues, margins, FY24 guidance of a 15 to 20% growth, margin improvement of 100 to 200 basis points is been liked by the street and is coming slightly ahead of expectations. Now the question is, what led to this kind of a super performance? Now, Cyient has classified its business into 4 key verticals. They've introduced they've actually diversified a lot more. So they have communications, they have sustainability, they have new products. But the segment which is firing for Cyient is the transportation vertical. This is about 30% of their revenue. In transportation, they cater to the aerospace companies, that's the airline companies, and they cater to rail transport. Okay, this is doing exceedingly well. We know domestic and international travel is, like sky high right now across the board, and the companies are willing to spend on their tech spend. So this quarter, the transportation vertical has seen a growth of 13%. And it's also coming out of a very, a deep cycle of weakness. In FY21, the transportation revenues had fallen 17% because COVID literally shuttered business for all these transport companies, the airline companies. So since then, things have been on the mend. Even in FY23, the first half was weak, which is why they're ending FY23 with a transportation revenue growth of 2.6%. But the quarterly trajectory will tell you that transportation is really firing for the company. And they are guiding that transport vertical will see a double-digit growth revenue next year. And they also threw up an interesting point in the call yesterday. They're saying the aerospace segment is due for a platform upgrade, which can happen anytime in the next 2 to 3 years, which can drive a super growth. A platform upgrade, which basically means a completely new tech architecture, and that could be a big driver over the medium term. And in the conference call, in our interview today, the management also said that we're on track, we're quite confident about achieving a $1 billion revenue run rate by the end of FY24. Looking good, firing on all cylinders right now, Cyient.
Let's also listen into what the management had to tell us at their, at the interview that we did have, the comments Rima was referring to. So let's get that bite in, and then we'll talk about some more action from the tech space.
we've taken into account some degree of macro uncertainty, which we all can't escape. But taking into account some degree of macro uncertainty, we're still quite confident that we have a run rate towards that number essentially in Q4 of this financial year. There is still a lot of work to do, but we believe, will we be there? Surely thereabouts, but we're working hard towards getting there. So that's still a line of sight. There are some obvious risks in areas like semiconductors where there is a slowdown that is anticipated. But I would say, I think now we have a well-diversified portfolio. If you look at the 4 reporting sectors that we have, which is transportation, sustainability, connectivity, and new growth areas, they're all very balanced. I mean, they're all, a fourth each of the services business. Or if you add the manufacturing business, that's also about the same scale. So these 5 pillars that we have, I think, are working out very well. And let's face it, right? There were times when some of the sectors that we were in did not perform very well compared to the others in the market. And I'm referring to the aerospace sector here particularly. But now that sector has come back quite strongly. So I think we've positioned ourselves quite well.
So yesterday it was Mastech and today it's Cyient. Good flavor and basically good sentiment from some of these mid-cap IT companies. But Rima, let's also talk about HCL Tech because, we've heard from them as well in the morning. You had that interview with them. I guess the street is relieved at least that it's not like a Infosys shocker. But what are the major takeaways? And the stocks are, not doing too much, at least for the time being. Well,
the stock has actually slipped 3% from the day's high. And I don't want to go over the numbers. We've gone over the Q4 performance, the guidance. Just want to talk a little bit more about the deal wins and the deal pipeline. While the deal wins have been healthy at more than $2 billion, the total contract value over the full year has only grown at 6.6% in constant currency terms, which in a way explains the next year's guidance of 6 to 8%. Also, what's happened is these deal wins are, because they're cost optimization, sometimes they spread over a longer duration. So the annual contract value has only grown at 4.3% in FY23, and it's sharply off compared to the 21% growth that we had seen last year. So, the annual contract value has seen a slowdown in terms of a growth rate, which also explains the company's guidance because they ended FY23 with a 13.7% growth and they are guiding for a 6 to 8% growth. Also, what's interesting is that HCL Tech's drivers were very different from Infi and TCS. Now, the problem for Infi and TCS was largely North America, BFSI, though in the case of Infi, there were also other verticals. But these were the 2 major pockets of weakness. But for HCL Tech, both these pockets did very well. North America was up 1.8%. Europe, in fact, declined for the company. And BFSI, 6.9% growth for the company and BFSI. So just wanted to highlight that for HCL Tech, the revenue drivers were very different from what we've seen in the case of Infi and TCS. It was North America and BFSI. The pockets that we thought were trouble actually did pretty well.
Absolutely. And that was the stunning part, I think, in the one of the main things that really stunned. And the management was very confident when they were speaking about the BFSI vertical, saying that they don't have exposure to too many of these small, mid-sized banks. And they didn't seem to at least face any hiccups there, Pavitra.
Oh, absolutely. And, as if there was not enough news flow from the tech space. You also have a recent note by JP Morgan after we did get some of these big earnings, right? They're talking about Tech Mahindra and Mphasis, a bit of a downgrade coming through.
So what they basically said is you've got 3 big companies, right? You've got Infi, TCS and HCL Tech. Across, if you pick up the pockets of weakness across all 3 of them, you can say that in the case of HCL Tech, their tech and telecom business was weak. In the case of Infosys, their retail, high-tech and telecom business was weak. In the case of TCS, BFSI was well. So all these pockets, in a way, are seeing some project cancellations, some project deferrals. Then they've identified that in the IT space, the companies with the highest exposure to these sectors, BFSI, retail, high-tech, telecom, and they come up with Tech Mahindra and Mphasis. And that's the reason for the downgrade. For Tech Mahindra, 40% of their revenues is telecom. And in the case of telecom, you remember, I think Infosys had said that they did face some project cancellations and deferrals. So telecom was a vertical flagged off by Infosys, and 10% comes in from high tech. Even for Mphasis, 62% revenue comes in from BFSI, a pocket which was weak, particularly for TCS, and 13% from high tech, which basically means for both these companies, majority of their revenues comes in from pockets where peers have flagged off some concerns. And this, according to JP Morgan, will drive some revenue and margin weakness for these 2 companies, which is why they have downgraded it today.
Okay. Okay, got that. So that's a pretty comprehensive view on a lot of the IT stocks that are hitting the headlines today. Let's take this conversation forward. Siddharth Khemka, head of retail research at Motilal Oswal Financial Services, is with us. Siddharth, good morning. We do want to talk about the overall market outlook with you, but have to start with IT, right? That's where the news is. That's where the price action also is. What have you made of things so far? We've heard from, I think, around, five companies, including the two mid-caps now. What's your stance on the sector, and what stocks are you recommending a buy on, if any?
Yes, very good morning. So I think I was hearing the discussion that you guys were having, and including the detailed discussion by Rima. There have been various segments, and each kind of showing different kind of growth as well as outlook. And rightly so, the views have changed for all the companies in terms of the segments that they are present in. If you look at clearly, TCS was marginally in line with expectations, not that a weak outlook, but Infosys clearly missed the trend, and even the outlook given by Infosys was very weak than expected, and that kind of you can say hit the sentiments very hard. But finally, there was some glimmer of hope with the mid-cap IT names like Mastech, Cyient now coming out with very strong numbers, and HCL Tech having a mixed number. I would say that not very disappointing, a decent set of numbers, and its defensive portfolio that it has, it is helping it to navigate in the current challenging macro environment. Clearly, if you look at Cyient, we are liking it in terms of very strong numbers that they have announced, clearly leading from the front in terms of the growth, in terms of margins, and in terms of the outlook also. If you look at the growth outlook, we believe that it would consistently show strong growth for next year as well. So if I were to look at it for the Q4, Cyient reported strong numbers with revenue growth of 39% Y-on-Y in constant currency basis. And the key segment that delivered growth was the consolidated services business. We are believing that Cyient on overall basis is shaping up quite well with positive momentum in most of its growth engines. And to top it all, valuations are still comfortable for Cyient at almost, you can say, a 1 year forward FY24 P of 14 times, which looks quite attractive. And that gives us more comfort in the strength that Cyient could continue to do well. So we have a target price of about 1360 from a 1 year basis, and we continue to remain positive on Cyient.
Siddharth, your pecking order between Infi, TCS and HCL Tech now, how would you rank them in terms of upside potential from here?
So yeah, clearly if you look at post the results, we believe that while we were preferring something like an Infi as our top pick, but I think after the results, we are looking a bit subdued performance from Infosys. TCS is, as I said, given an inline performance, but in terms of pecking order, I would say HCL Tech would be preferred because of its defensive portfolio, followed by TCS and then Infosys.
Okay, got that. Siddharth, thanks for joining us. I also want to ask you about some other stocks. I know that you like Lemon Tree, so take us through the call there. What is the kind of upside that you see, and anything else that you like from the hotel space?
Yeah, so I think the hotel sector has been quite resilient in this entire environment. The sector continues to do well. It is likely to expect one of its best fiscal on back of the improving economy, growing travel, both leisure as well as business travel. The sector is witnessing very strong ARRs, which are likely to improve 10 to 15% this year, already on back of a high base. And if you look at the occupancy, that is being sustained at a higher level, 68, 70, 75% is the average occupancy that the sector is witnessing. So if you look at specifically Lemon Tree, there are some of the other smaller hotel companies which came out with results, which have come out with record earnings for Royal Orchid and some of the other companies. But if you look at Lemon Tree, we expect the earnings momentum to continue on back of occupancy, resilient demand, especially given that it caters a lot to the business travel segment. It is looking at aggressive expansion plans, so plans to add 35 hotels, 2,000 rooms over the next 1-2 years. So we are looking at a consistent growth in revenue of about 27%, PAT growth of about 36% over the next 2 years, and more importantly, ROEs, which we have seen that consistently in hotels are low single digit. For Lemon Tree, it is likely to improve to 21% by FY25. So overall, we have a buy view, a strong upside of almost 115 rupees target from a 1-year perspective. We also like Indian Hotels, which is doing well, which is a market leader. But I think in this environment where both will do well, Indian Hotels, the results is also expected to be pretty strong.
That's Siddharth. Lemon Tree, of course, has done well in the recent past. Thank you for joining in today. You have a good weekend and appreciate you taking out the time to be with us. We'll take a quick break on that note. On the other side, all about commodities with Manisha Gupta.
Welcome back. Not much happening in equities. ITC, by the way, has moved to the high point. It's a fresh 52-week high on ITC, and with that, the stock has gained close to about 1.5%. So that's a pocket seeing some buying today. But let's talk commodities then. Manisha is here to tell us more, and she's got her eye on crude oil prices once again. Manisha.
Well, thank you for that. Yes, after 4 weeks of constant gains for the crude oil prices, this is 1 week that we are looking at very sharp declines coming in. Overnight, the crude oil prices have declined by 3%. So with that, we are trading at a 3-week lows now. And the Brent price is just ready to break that $80 per barrel mark on the lower side as well. So when you look on the week, we are down 6%. On a monthly basis as well, we have come down, still holding 9% in positive, but we have come off sharply from the kind of gains that we have seen in the month itself. Well, the US is expected to hike interest rates by 25 basis points in the month of May. Much of that has been factored in, and that is a 90% probability of that right now. But the markets are also now looking at the month of June, where another 25 basis point rate hike is being talked about, and that's weighing onto the markets. Not just US, you have similar conversations coming in from Australia, Bank of England and ECB as well, and that is leading to demand concerns in the world that is weighing on China as well. While the first quarter GDP numbers came in on the stronger side, but all other data has been slightly weak, so the recovery has been uneven. In the US markets as well, we have seen a big build-up in US inventories and a build-up in case of gasoline and distillate stocks as well. So that demand also continues to be weak. In any case, US economic data has all come in on the weaker side. And then the markets are looking at the Russian exports, which have actually, with the output cut as well, are now at a 2019 high. So we are at a pre-COVID high when it comes to Russian exports. So there is supply coming in and demand a bit of a concern, and that's weighing onto the markets there. What the street also is watching out for the EIA numbers, which suggests and tells you that the US production as well has been increasing, now at 12.1 million barrels per day. So everywhere the production is increasing, export numbers are higher, and demand is something that the street is worried about.
Okay, and on the back of that, your crude price is sliding, like Manisha said. Manisha, thanks a lot for getting us that quick update. That is on crude. With that, we do need to get into a short break now. But on the other side, we're going to talk about Reliance Industries. We will get you all of the expectations ahead of their Q4 earnings today. Stay tuned. Welcome back. You're still tuned into Trading Hour. The big stock in focus today is Reliance Industries ahead of its fourth quarter numbers. It will go sometime in the evening. So we're watching out for those numbers. Ahead of that, let's get you a complete preview on what we can expect this time around. First up, we have Sonia standing by with all of the key expectations from the company this time around. Sonia.
Well, it's a big day. Reliance Industries is all set to announce its Q4 earnings. Remember, the stock is down 7% in 2023 so far, but it's a decent quarter expected this time around. First, let me take you through all the key numbers that you can watch out for. On the revenue front, it's about an 8.5% growth that we're looking at compared to last quarter. While on the EBIT, the EBITDA could see a growth of around 5.2%. Margins could be a tad bit under pressure compared to what Reliance did last quarter. But on the profitability front, it's a 12% growth that we're looking at somewhere around 17,700 crores. Now, as I said, both the consumer as well as the commodity businesses for Reliance Industries have done decently well this time around. First, let's take a look at the oil to chemicals business, which is the key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them. In fact, looking at the gross refining margins, Singapore gross refining margins improved to $8.2 a barrel in Q4 compared to $6.3 a barrel last quarter. There's also a demand improvement seen because of the China reopening, and that has aided the numbers this time around. In the consumer-facing businesses, Reliance Jio has slowed down a tad bit, so we are seeing the revenue and the profitability growth moderate for them. In fact, it could be the lowest in the last 7 quarters. On the average revenue per user as well, it could be absolutely flat this time around at 178 rupees. A couple of reasons for the slowdown, but primary reason is that there's been an absence of a tariff hike, and that has caused Reliance to see a slowdown in its growth rate in the telecom business. Let's move to retail now. Retail growth is expected to be about 6% on a sequential basis, coming in at a little over 46,650 crores. These are the recommendations put out from Nomura. And on the EBIT side, we're expecting about 3,800 crores versus 3,600 crores last quarter on a sequential basis. So clearly, as you've seen, there's a decent growth expected. Some of the businesses like Realty could see a bit of a slowdown, but it could be offset by good growth in the oil to chemical space.
Okay, so that's an overview. Now let's go segment by segment. Rima earlier recorded an update on what to expect from Reliance Jio.
Well, it's expected to be a modest quarter for Reliance Jio this time. We're looking at a revenue growth of 1.8% on a quarter-on-quarter basis. And this, by the way, will be the slowest revenue growth that we've seen in the last 7 quarters. The key reason for that is the absence of a broad-based prepaid tariff hike. While the company has been getting a bit aggressive on the postpaid side, they've introduced a lot of family offerings, it doesn't move the needle on the top line. On margins, the company's margin trajectory has been upward, and this quarter too, we are anticipating a 40 basis points improvement in margin sequentially, driving a 2.5% increase in the profitability. 2 key operating metrics. One of it is subscriber, which is basically your volume growth, and the other one is ARPU, which is your pricing growth. So in the month of January, according to the TRAI data, the company added 1.65 million subscribers. So analysts are anticipating that for the full quarter, the subscriber addition should be about 5 to 6 million. In terms of ARPUs, the average revenue per user, it's seen flat on a sequential basis. 178 rupees is the ARPU estimate according to consensus expectations. And as I said, the key reason for the ARPUs being flat is the absence of a large prepaid tariff hike.
All right, so that is on Reliance Jio. The next vertical, Reliance Retail, is expected to see strong growth on a year-over-year basis. So Mangalam is here to tell us more on that and take us through the individual numbers that we should expect this time. Mangalam.
Well, for Reliance's retail business, it's already been on a big growth path. So this time around, year-on-year growth as well as quarter-on-quarter growth is something that the street is working with. Remember, usually post the third quarter, there is a slump, but the company's store expansion will offset this post-festive season slump as well. And year-on-year, the numbers will look much better because of, one, the network expansion, and secondly, a strong, favorable base for the company because of Omicron-related issues in the same time last year. So quarter-on-quarter, revenue is likely to grow by 4.5%. For the first time, it crosses that 70,000 crores per quarter mark. The EBITDA grows by 2%, just under that 5,000 crore mark, which means that the margins for the company meander around that 7% mark itself. These are Nomura's expectations. Year on year, like I said, a 22% growth in the revenue looks much better, a 31.5% growth in their EBITDA as well. The company's foray into the FMCG business, Independence, the brand that they launched a couple of quarters ago, is something that we'll be watching out for. Apart from that, they've expanded their horizon as well, entered into the personal care and home care categories too. And more than anything else, they've recently launched the beauty care platform too. So these are some things that we'll be watching out for. The heat wave is on, so the acquisition and launch of Campa as well as Socio is something that the street will be watching out for. But that may be more of a first quarter phenomenon, and eventually Metro AG's India business coming into them is also going to help the retail business grow the growth path that it already is on.
Okay, got that, Manglam. Well, let's also talk about the main business, the O2C business. Sonal has a preview on that.
Well, it is expected to be a good quarter for the auto chemicals business for Reliance Industries for a couple of reasons. Let me start with the first one. Crude oil prices, they are down both on a YOY basis and sequentially. 19% fall on a YOY basis is what we've seen, and 8% on a sequential basis. Additionally, Singapore GRMs, they have improved to levels of $8.2 per barrel in quarter 4 of FY23. Now, what will this do? We have seen demand improvement because of Chinese economy reopening. While Chinese economy has reopened, exports have gone higher as well, and that is something that will cap gains as far as product spreads in the petchem segment is concerned. So yes, petchem and refining will see a sequential improvement, but petchem will still be subdued versus historical averages. Now, let's take a look at some of the estimates. Jefferies thinks that the company will see a 10% sequential increase in the O2C business and 7% on a YOY basis to come in at 15,249 crore rupees. And if we just take a look at how O2C has been contributing to overall EBIT, it was at one of the highest levels back in quarter 4 FY22 at 91.8%. It did see a fall from there, but it has been increasing since then, and this time around it will be seeing higher levels of around 80%. This is as per ICICI Securities. So yes, it will contribute more to the business this time. Moving on to the GRM number, the company does not report it anymore, but there is an expectation that they will improve to $12.8 per barrel, which is an increase both on a YOY and on a quarter-on-quarter basis. Now about the upstream segment, it has been doing really well for the company, and it will not be an exception this time as well. 5% increase on a sequential basis, more than 100% on a YOY basis is what the upstream oil and gas business will do this time in terms of EBITDA. So both oil and gas and auto chemicals will definitely be the stars this quarter.
All right, that is on the O2C business. Sonal, thanks a lot for that. Standard Reliance disclaimer on your screen. It owns and operates the channel that you're currently watching. That is on Reliance. But with that, we are going to get into a short break now. When we come back, we're going to focus on the markets and bring you a technical check with Mitesh Thakkar.
Welcome back. Still very, very subdued for our markets. Down 25 points in the Nifty, Sensex down 57 points. Where are we headed? We've not gone anywhere, at least in the last 5 days. We've just been moving around. Mitesh Thakkar is with us now for a technical check on the markets. Mitesh, 17,600. I pretty much can bet that the same time we spoke to you yesterday, also we were at 17,600. In that broad range, we've been holding on to it. So any thoughts on, where do we go from here? And what about individual stocks? At least that's where some action is there.
Morning, Rima. I think you can make it day before yesterday as well. I think we've been so flat for the last few days that hardly any kind of movement has taken place. And overall, the understanding is that we might actually just chop around and be in this range. The good thing is that we're not breaking the lower end of the range, which is around 17,550. In fact, 17,570, 17,550, and that's also the 200 average area. I think has become a good pivot. And I think, broadly, as long as we don't break that, there's a good chance that in a day or two more, I think this consolidation should end and the market should resume its upward journey. So 17,550, 545 remains the level to watch. With that, I think the stock, which I'm trading is Kotak Bank and ITC. Kotak Bank, is a buy. It's gave a good breakout and then was consolidating for the last 3 days. Today is picking up steam again. So buy here with the stock just below 1875. Look for 1940 as the target. And ITC, I think at the beginning of the show, you highlighted this one. It's just made a fresh high, so it should see more continuation. We'll keep a tight stop loss because it's overbought. So keep a stop at about 401 or maybe 400.5. And look for targets around 414, 415 on the upside.
Okay, got that. Mitesh, thanks very much for joining in. I think by the time, if things don't change, by the time the day closes out on closing bell, we'll ask you about your weekend and holiday plans if the market doesn't give us anything else. Thank you for joining in, and catch you later in the afternoon. We'll take a break on that note. On the other side, we turn the spotlight on IndiGrid. This InvIT has raised about 1,140 crores from the International Finance Corporation. These are long-term NCDs. So why are they raising the money? What are the business plans like? We will talk about the company's management. We'll talk with the company's management. Welcome back. You're with us on Trading Hour, and we have Harsh Shah, CEO of IndiGrid, joining in. Now, the InvIT has raised long-term NCDs from IFC, and this is to the tune of 1,140 crores. Thank you, Harsh, for being with us on the show today. First things first, let's understand all the dynamics around this fundraise. Where does it take your total debt levels up to? What's sort of the outlook on the business going forward? Will you be using some of this money perhaps to acquire more assets in this year?
Sure. So this takes our debt level to slightly over 14,000 crores. Our assets under management today are about 22,000 crores. However, this facility is largely going to be used towards investing in prepaying certain other debt obligations. So it's not going to be a net addition to our borrowings. It's rather converting some of our, I would say, maturing debt to a really long-term profile. In terms of business, we continue to remain strong. We did about 2,000 crores of acquisition last year across different assets, and we are looking to do more this year.
Oh, okay. So basically, this is in a way, this is refinancing, and you're looking, as you said, at changing the profile to long-term debt. What about interest rates? What rate have you managed to raise this money from? What are your blended borrowing rates? And how is that picture moving?
So this is pretty much in line with our blended borrowing cost, but a very competitive rate. We have raised it at around 7.7%, which we think is a fantastic rate for a corporate borrowing for long-term tenor. So that's the cost of debt at which we have raised this capital.
Okay. Hi, Mr. Shah. Thanks for joining us. This is Pavitra. If we can get a word in on the acquisitions, is there anything that you're looking at right now in terms of acquisitions, especially, with regards to Sterlite Power or anything else as well?
So we acquired one project called KTL from Sterlite Power just about a month and a half back, which is about 1,500 odd crores. So that is the latest one which we have concluded. Other than that, we keep looking at different types of assets, not just acquisition, but also bids. We have bid last year in one of the transmission assets, and we are building that. We are in process of participating in battery energy storage, and we look at consolidation play in some of the renewable assets as well. But nothing at the moment to really worth announcing.
Harsh, is there any correlation between high interest rates and the kind of dividend you can distribute back? Will the current high interest environment that we're in depress the dividend returns from you?
The way we try to mitigate this risk is that we largely borrow long-term and fix our rates. This facility with IFC is one of the key facility in that. And therefore, we are, to some extent, the cost of debt, we are neutralizing the impact by borrowing long-term and fixing long-tenor loans. And therefore, even in our portfolio, we are not getting materially impacted with the current high rates because we have already fixed our borrowings to a great extent. And therefore, we don't see it getting impacted by any in a near or midterm future in terms of our distribution profile.
Harsh, on a separate note, I'm just trying to remember exactly the amendment that came in after the finance bill, which is basically the distribution that was happening with respect to business trusts, the distribution that was happening by way of repayment of debt. I think that now will also get taxed. I'm just trying to understand what are investors saying, and does that at all impact the sentiment in terms of the net yield at the end of the day that an investor makes?
I think it partly impacted for the month of the budget in February, I would say, when the announcement came in. However, nothing has changed. In the past also, most of the, I would say, sophisticated investors with an advice from right accountants always adjusted the capital repayment portion from the cost of acquisition of units. And therefore, eventually, when somebody sells it, they would have paid capital gains on that. So I don't see any practical change on ground, except that now CBDT and budget is clarifying the position and fortifying that, which makes it easier to execute and implement across different investors. Earlier, there was, I would say, some cloud in terms of interpretation of that between different set of investors. But from our perspective, we were clear that this is to be adjusted from cost of acquisition. And that's what most of our investors have used it as. So we don't see it as a negative anymore once the finance bill is clarified the same.
Okay, got that. So just to go back to the business headlines, you're saying you're not looking to acquire any more assets in the near future at least. Leave us with an outlook in terms of top-line growth, profitability, margins. How do you see this year?
Sure. So based on the assets that we acquired this year itself, we will look at some like 8 to 10% growth in terms of run rate of this year, in terms of our just top line and EBITDA numbers. In terms of the outlook, we are very, very confident of the energy transition growth that is taking place in India. And for a normal investor, there are limited plays that they can play on the energy transition stories in India in a safe manner. And we do represent that opportunity because we are across transmission, renewable, and battery energy storage. All of them are at the very center of the energy transition. However, they are safer to invest relatively versus a general development business. So we are at a pretty much interesting place in terms of the growth that we see in energy transition in the country.
Harsh, we'll leave it at that. Thank you very much for joining in. That's the word coming in on IndiGrid. We will slip into a very short break. We'll come back with more on the market. Stay tuned.
Welcome back. You're still tuned into Trading Hour. For the market, it's around a 20-point cut that we are seeing right now. And today, like we've been telling you, it is the broader market which is seeing more pressure. So the mid-cap index is down 160 points right now. The Nifty bank has slipped a little bit more, so around 90 points gone over there. But the big earnings to watch out from the Nifty bank is going to be tomorrow. That is ICICI Bank will post results tomorrow. So Abhishek is standing by to tell us what we can expect this time around. Abhishek.
Well, Pavitra, ICICI Bank is expected to report numbers tomorrow, and as per analyst poll, the street is anticipating the highest NII growth rate in last 8 years, which will lead to all-time high in terms of quarterly profits, nearly about 8,900 to 9,000 crore as per our poll. So what are the key things to watch? Loan growth that is expected to be around 18% YOY and more than 4% sequentially, which is as per Phillip Capital estimate. The net interest margin is expected to improve. So quarter on quarter, Phillip Capital is estimating net interest margin to be at 4.7% versus 4.65% in the previous quarter. This 4.7% could be a 8 to 10 year high in terms of net interest margin or at all-time high. So provisions to decline quarter on quarter due to decline in stress assets in the balance sheet. Phillip Capital estimates slippages at 5,000 crore. Previous quarter, it was a little more than 5,720 crore. Phillip Capital also expects, asset quality to improve. So gross NPA as per them could come down to 2.9% when compared to 3.1% in the previous quarter. Now watch out for two key numbers how that book moves. One is the watch list, which is about 0.57% of the loans, and the restructured book, which is about 0.5% of the loans. So our poll suggests NII growth of nearly 36% YOY and about 4% sequentially. We are working with a profit growth of nearly 28% YOY and about 8% sequentially. Back to you.
Okay, got that. Thank you very much, Abhishek, for taking us through the preview. Well, let's move forward. What we're also looking at is some interesting traction in footwear stocks. And this has been on for the last 2 or 3 sessions. Even today, if you're looking at some of the names like Mirza International, I saw was still about 6-7%. There is Liberty. Liberty, of course, in the morning was popping really higher. but now it's up just about 4 to 5%. So is this just some sort of a trading play? Is there something more to it? Well, Nuvama has written a note on it. So let's straight away get to Mangalam to understand what's going on. Is there a shoe story here, or is just, funny trading going on, Mangalam?
Well, there could be funny trading going on, but structurally, there is a story for the shoes for the footwear industry, so to say, itself. And Nuvama has pointed out some data, and if one is a shoe lover, one would already know that, this is what the thesis is. The first one, of course, is that India's organized footwear market is just about 30%. The rest is unorganized. And the organized footwear industry, because of the GST, is obviously growing faster at 13% over the last few years, as against the industry, which is growing at 9%. In that, the category which is growing the fastest, and for those who wear this increasingly post-pandemic, the casualization of footwear is something that the street likes. So, everyone knows that sports and athleisure is something that is growing at 17%. And in that as well is the premium end, which is expected to clock a higher rate. The other thing that has happened is that we've been buying our footwear online more than offline. So, which was 16% as a percentage of sales, is likely to be something all the way up to 22% by FY25 expected earnings. So if you just take a look at what Nuvama has said, they've initiated coverage on metro brands with a buy rating and a target price of 978, indicating a much higher upside. For Bata, they've initiated coverage, but they have a hold rating with a target price of 1548. Why is that? Because for Bata, they believe that the company is in the midst of changing their positioning from something which was just a value footwear store to something which is now fashionable, and with the sneaker studio, etc., that they've come up with. So they will be watching that to determine a sustainable same-store sales growth trend in Bata. Until then, hold Bata and buy Metro shoes.
Thank you very much for that. And Apple putting its weight behind India as a manufacturing hub has got the street very excited. In fact, Haitong is fairly bullish on India as an electronic manufacturing services market. They've initiated an outperform call on the recently listed companies from this space. Surbhi is here with the details and the highlights from this Haitong report. Surbhi.
Thanks so much for that. So Haitong has released an extensive report on the electronic manufacturing space in India. They say that India stands out in the global EMS space as India is set to grow faster than the industry. India is expected to grow at a growth rate of 33%, whereas industry growth rate is pegged at 26%. According to them, this growth is fueled by conducive policy framework which allows incentives. Also, company capitalizes on the fact that India has a higher proportion of skilled labor with high quality design abilities. They have initiated coverage on the 3 recently listed companies in this space, which is Keynes Technology, Syrma SGS Technology and Avalon Tech, in that order of preference. They have an outperform rating on all 3 with a Keynes Technology target price of 1350, a potential upside of 44%, Syrma SGS Technology target price of 370 with a potential upside of 27%, and Avalon Tech with a target price of 535, a potential upside of 36%. The investment thesis across these companies is that there is going to be significant tailwind in the sector due to 1, strong order backlog, 2, higher inquiry levels by global peers, and 3, increased trust on localization. For the next 3 years, they are penciling in a compounding revenue growth rate of 54% for Keynes, 41% for Syrma, and 20% for Avalon Tech, and a compounded PAT anywhere in the range of 35% to 80%. When it comes to valuation, they value these companies anywhere between 21 to 23 times FY25 PE, close to a 25% discount when you compare it with the industry leader, which is Dixon Tech.
Okay, got that. Surbhi, thank you very much for joining in and giving us the update on that. A pretty interesting niche sector. Well, ladies, with that, it's a wrap.
On Trading Hour. Thank you for watching. But stay tuned. Halftime Report is up next.